So good morning to everybody. I'm very happy to welcome John Fell and all of you that have decided to participate to this joint event. It is a joint event with the Leibniz Institute SAFE. SAFE means Sustainable Architecture for Finance in Europe, and CEPR. And we are, welcoming today John Fell, and that is going to present the Financial Stability Review, the last version of the Monetary Authority, let's say, presentation regarding the Financial Stability Review. Let me just introduce John, that he was so kind, to participate to this event as a representative of the European Central Bank. So John Fell is the Deputy Director General Macroprudential Policy and Financial Stability. And on top of this, he's really playing a lot of different roles, either at the ECB, but also at the international, let's say, level. So he's chair or co-chair of several international working groups, including the Eurosystem Macroprudential Policy Group and the European Systemic Risk Board. Actually, I'm sharing a lot of meetings and discussion at the European Systemic Risk Board with John, and I must recognize that all the time he was really great in giving, in a very quick and short time framework, a very nice picture of, let's say, the different topics that he was going to address, mostly on the current situation of the capital markets and so on. He is also a member of the ESRB task force on stress testing, and then he's playing really several roles internally and externally to the ECB, including, for example, he's an expert of the crisis management experience that we had also in Europe during the sovereign financial crisis, for example, including negotiation between the European Union and the IMF for financial assistance program in several Euro areas countries. Prior to joining the ECB, and I would like to stress that he joined the ECB in 1998. So he is really part of the ECB from his starting, and he knows all the evolution that the ECB had during the last 20 years. He was also, again, at that time, playing several positions at the European Monetary Institute. And so this means that really he knows very well all the evolution of the European monetary system from the beginning. He graduated at the University College of Dublin in Dublin City University, well, unfortunately, several years ago already. And he's also, a PhD candidate at the Rotterdam School of Management. But I'm not going to spend other time. I'm welcoming him that is going to talk about this document that, of course, is having several parts that are relevant, the corona pandemic and the impact that it gets on the Eurozone, but he's going to point to several aspects. On one side, what are the impact of the current crisis on the corporate balance sheets, on bank profitability, and on the increasing potential, or maybe not, credit risk for non-bank institutions. He's also at the margin spending some time talking about climate change and the risk that climate change poses to financial stability in the Euro area, and how also the ECB is assessing the climate-related risk to financial market, banks, and non-banks. On top of the presentation that John is going to give to us, there will be then a lot of time dedicated to discussion. So I'm already asking you to use the Q&A facility that we have. And, already during the time that John is presenting, please pose your question there, because we will have about 30 minutes where we have an open discussion on this report and all the issues related to that this report clearly is pointing to. So now I'm giving the floor to John. Thank you very much for being so kind to dedicate your time to us. and make us aware of all the different aspects that this report is going to point out. Thank you very much.
Thank you very much, Loriana, and thank you very much for that kind and generous introduction. Good morning, everyone. So let me first thank you, Loriana, and also SAFE for giving us this opportunity to present the highlights of the May 2021 issue of the ECB's Financial Stability Review. This is actually the third issue of the Financial Stability Review that we have prepared against the background of the COVID-19 pandemic. Now, the context in which we prepared our assessment was one where daily global infections reached record highs, but they are coming down. So each issue of our Financial Stability Review covers backward looking in the last 6 months, and we're looking out over a horizon of, let's say, 12, 18 months, 2 years, something like that. Many euro area countries are now emerging from a third wave of infections, and at the same time, evidence on the efficacy of vaccines provides grounds for optimism. In those countries where the vaccine rollout has been fastest, and here I would include Israel, the UK, and the US, we see that infection rates have dramatically declined. And although Europe got off to a slow start, the pace of vaccination has been picking up. So compared to the assessment that we made 6 months ago, we are now cautiously upbeat. So turning to slide 2. Now, while the FSR covers many topics, I mean, I cannot hope to present everything, so I'm going to focus my presentation on 4 themes. So first, we have witnessed very differentiated impacts of the pandemic across euro area countries, depending on economic structures, as well as health and economic policy responses. And the result has been a clustering of vulnerabilities in some countries of the euro area. Second, in the US, the combination of a sizable stimulus package together with optimism about the pace of vaccine rollout caused bond yields to rise abruptly in February and March. The so-called reflation trade put treasuries on course for actually their worst quarter since 1980. And the spillovers to other asset markets served as a wake-up call about the vulnerability of stretched asset price valuations to low discount rates. Third, investor sentiment towards euro area banks has become distinctly more optimistic. We have a more cautious view, especially given uncertainties about the adequacy of provisions to deal with rising non-performing loans. And fourth, as you mentioned, Loriana, this issue of the FSR includes a special feature that looks beyond the pandemic to the risks that climate change poses for euro area financial stability. It finds that all parts of the euro area financial system, so that's banks, funds, and insurers, face material climate-related financial stability risks. Let's go to the next slide. And the first theme, as I already mentioned, vaccine rollout in the euro area has speeded up. In fact, as you can see on the left here, the shaded area shows that some countries are slower and others are faster, but on average for the euro area as a whole, it is around 6 weeks behind the US. Nevertheless, as you can see on the middle chart, there has been more or less continuous downward revision to consensus expectations for euro area GDP this year. And this contrasts with the US, where the fastest pace of growth since 1984 is expected this year, and you've had continuous upward revision, and the economy surpassing its pandemic size, or expected to surpass its pre-pandemic size before the end of this year. That said, the middle chart also shows, again focusing on the range, that the cross-country pattern of recovery in the euro area is expected to be K-shaped, meaning some countries are doing much better than others. The pattern of sectoral recovery is also K-shaped, as you can see on the right, with manufacturing performing much better than services. And these differences in growth trajectories underpin the clustering of vulnerabilities that we're seeing. Now, moving to the next slide, and the second theme, while taperless, as I mentioned, the US bond market went through a tantrum nonetheless, in part reflecting an inflation scare, and together with a strengthening of the US dollar, which had not really been expected at the beginning of the year, expectations of higher US interest rates caused asset price declines, not only in the US, but also across the globe, including in emerging markets and in the euro area. The episode was short-lived, though, as inflation expectations seemed to stabilize, and that set the stage for an extension of the global equity price rally. And you can see that there on the middle chart. By early May, global equity prices were 75% above their pandemic lows and almost 40% higher than their pre-pandemic levels. Now, we think that signs of misalignment of equity prices from fundamentals are clearest for the US, where US stock prices are significantly above historical averages for price earnings ratios and indeed for other valuation metrics. But for the euro area, stock prices are on average closer to historical averages. That doesn't mean, though, that we have no concern about equity price misalignment in the euro area. If you look at the chart on the right, I mean, that's showing frequency distribution of forward price earnings ratios. And you can see that the median, the mean has not changed too much, but the strength, too much relative to historical averages. But the strength of equity markets has created a fat tail of firms with very high price earnings ratios, also making them vulnerable to correction. So you can see that from the red frequency distribution, which has, when you can see it's more compressed and it has more mass in the right-hand tail than historical averages of those distributions. And so we have historical averages for 2 decades, the yellow and the blue frequency distributions. Now, going to the next slide, and in view of market anxiety about the future course of US monetary policy, a key question on this side of the Atlantic is, what would be the effects of a rise of the US federal funds rate on euro area financial markets? And we look into this question in some depth in box 3 of the review. Specifically, we asked the following question: suppose US interest rates were hiked sufficiently, and so that's with some reverse engineering, to cause a US stock market correction of 10%. How would euro area stock and bond markets respond to that? And the answer is shown on the left here. It would likely produce an equally large equity market correction in the euro area as well, and a significant widening of corporate bond spreads, especially for high yield bonds, which you can see on the right. The spreads are currently at historical lows, but also indeed for investment grade. So euro area financing conditions in such an event would tighten, and of course investors would face large losses in this scenario, and those losses could in turn be amplified by leverage, where we do see some elevation. Now, turning to the next slide, the next question is, so now we know what would happen to the asset prices. Question is then, which parts of the financial system would be hit hardest by a rise of US interest rates? And the sector that seems most vulnerable is the investment fund sector. As seen on the left, like all other sectors, it has increased the duration of its bond exposures. All other sectors except for the banking sector, by the way, but it's increased the duration of its bond exposures over the last 5 years, but different to other sectors. The balance sheet is not hedged with equally long duration liabilities. So think about the other side of the balance sheet of a life insurer or a pension fund. Those liabilities are often as long as are close to in length of the assets. So as the middle chart shows, close to a quarter of the debt exposures of euro area investment funds are US exposures, and more than 30% are dollar denominated. And at the same time, the investment fund sector is more exposed to the euro area corporate bond market than is any other sector. So apart from the credit risk resulting from a weakened corporate sector, and I'm going to talk about that in a minute, the results of these simulations suggest that the investment fund sector is especially vulnerable to a rise of US interest rates, because it would affect both its exposures directly to US fixed income assets, but also to the corporate bond market. Let me go to the next slide, and continuing with the topic of, of corporate sector credit risk, different to what expectations might have been a year ago, or maybe a little bit less than a year ago, a little bit more than a year ago, sorry, Euro area insolvencies have so far not increased. In fact, they have declined, as you can see there on the left. And of course, this is largely thanks to the favorable financing conditions supported by the ECB's monetary policy, as well as the provision of government loan guarantees and statutory moratoria, which meant that firms largely avoided liquidity problems as their cash flows dwindled. Now, there wasn't space to include it on the slide, but in March last year, Moody's published projections for corporate defaults under 3 scenarios. And they had a baseline, they had a pessimistic scenario, and they had an optimistic scenario. So this was last March. Actual default outturns have not only been better than the baseline, but they have been even better than the optimistic scenario. So really, the progress on the time pattern of insolvencies and defaults has not really been what we might have expected a year ago. It's been much better than expected. But as supports are lifted, insolvencies and corporate bond defaults are expected to rise, especially as we know, it's going to take time for firms to recover revenues. Ultimately, what matters also, I mean, so the probability of default we think has risen, but it's important also what the loss given default rates would be. And of course, they depend inter alia on how indebted firms have become since COVID. So looking at micro data on the middle chart, most firms managed to avoid a significant increase of their leverage. There was some, I mean, the scales are quite wide because I want to contain the 10th percentile there. So those are the most highly leveraged firms. But you can see that the blue line, the median, it went up somewhat, but not really in a marked way, and certainly not in the same way as the 10th percentile. So there's a tail of firms which were already highly leveraged before the pandemic, which have since leveraged even further. And of course, these are the firms that we worry about the most. Banks have sizable exposures to some of the sectors that were hardest hit by the pandemic, and you can see that there on the right. The sectors like wholesale and retail trade, transport and accommodation. I mean, these are sectors where we're expecting that insolvencies are likely to be highest going forward. You might be surprised to see that real estate activities are not. So we've color coded that chart on the right for less sensitive in blue, more sensitive in yellow. You might be surprised to see that the real estate sector is marked in blue. So it's not considered a sensitive sector from the point of view of the banking sector. And the reason for that is that the bulk of the exposures to hard hit commercial real estate actually tends to be with foreign investors and investment funds, and not so much with banks. Let's go to the next slide, and residential real estate markets. I mean, they proved remarkably resilient through the pandemic, and I mean, much better than I think, certainly on residential property, and much better than I think anybody would have expected ex ante. And that was thanks to both demand and to supply side. You can hear household income was propped up, policy support, something different to earlier crisis where the decline in GDP also meant a fall in household incomes that we didn't really see because of all the supports. And of course, household savings surged as well, and I mean that gave people down payments to buy houses if they wanted to. Also, we had lower interest rates supported by debt servicing, and of course, I mean, we know that remote working has played a role as well in housing demand. On the supply side, subdued construction activity, of course, added to upward pressure on prices. And as a result, in many countries where there were already signs of house price overvaluation before the pandemic, house prices have become even more stretched, as seen on the right. And by stretched, I mean there is a part of the price level that cannot be explained by the fundamentals. Now, unless the economic recovery is weaker than we are expecting, we don't consider imminent house price corrections to be likely. Rather, we are expecting some moderation of house price inflation as the fundamentals catch up with prices. That said, if insolvencies were to surge, unemployment would follow, of course, and a correction of house prices would arguably be inevitable in such a scenario. Now, that's not our base case. For commercial real estate, the story is different. Here, we have already been seeing a correction, especially for retail commercial properties, and prices for office properties have also been subdued. You can see that there on the left. And as I said, banks' exposures to commercial real estate are limited. In fact, they account for around 7% of non-financial sector exposures of banks. But domestic investment funds and other non-bank investors could suffer losses on their exposures to this market. Let's go to the next slide and sovereign debt sustainability risks. So the cobweb on the left here is an attempt at a holistic view. I mean, it's complicated to assess sovereign debt sustainability, many moving parts. And so what we do here is try to compare a number of fiscal vulnerability indicators with the situation at the height of the global financial crisis in 2008 and the euro area sovereign debt crisis 2012. Now, while we cannot say that risks are lower today than they were in those episodes, you can see from the cobweb that the sources of risk are quite different. So vulnerabilities from the outstanding stock of debt are clearly higher today, and of course that's due to the considerable fiscal impulse that we had. But debt servicing and rollover risks are more benign, and of course, and that's thanks to, of course, continued favorable sovereign financing conditions. So our assessment is that near-term risks are mitigated by these favorable financing conditions, but this could change if, for instance, continued fiscal support was required, or if growth outturns were to fall short of expectations. Let's go to the next slide and the third theme. It wasn't really until news about discovery of effective COVID-19 vaccines that investor sentiment towards the banking sector started to improve. And since then, euro area bank stock prices have risen by almost 60%. And of course, that has lowered the cost of equity for banks as well. Now, as analyst expectations for banks' return on equity didn't change much after the vaccine news. And you can see this by looking at the light blue line on the left chart. The reason for this impressive increase seems to be mostly due to lowered uncertainty about the outlook. We now have full year 2020 data for euro area banks' performances, and it's clear that the pandemic had a marked impact on their profitability, and you can see that there on the middle chart. And it's primarily, I mean, the bulk of the erosion of profitability last year was because of higher loan loss provisioning. Now, what we also see is considerable heterogeneity across the euro area banking sector, with banks in some countries, and you can see that there on the right, with banks in some countries reporting performances that would have been considered decent before the pandemic, while others endured sizable losses. And that comes back to the theme of a clustering of vulnerabilities that I mentioned at the beginning. Now, moving to the next slide, we expect that the banking sector will be confronted with strong headwinds in the near term. Large inflows into IFRS 9 stage 2 category assets last year, you can see it there on the left, indicate that asset quality is deteriorating. And the ECB bank lending survey, you can see that there in the middle, has been showing that banks have become more risk averse in their lending. We're expecting that net interest income will decline further this year, and that's both because of lower margins and because of lower volumes. It's explained in more detail in the review. Now, since our analysis was finalized, I mean, we have a cutoff date for the latest data that we put into the review, and we didn't include an analysis of the very strong results of large euro area banks for the first quarter of this year, which in many cases beat the analyst forecasts. Those results wouldn't, however, cause us to change our assessment of the challenging times ahead for the sector. And the reason for that is because half of the improvement was driven by trading income, while provisioning was also very low. We still have doubts whether provisions will prove adequate to cope with the rise of non-performing loans that we're expecting. Now, turning to the next slide and the fourth theme, there isn't time to do justice, and I'm seeing now that I'm getting close to the end of my time. There isn't time to do justice to the analysis and this special feature on climate-related risks. So let me just mention a few key messages. First, new data collections and methodologies reinforce previous ECB findings of the potential systemic relevance of climate-related financial stability risks. Second, we find that risks appear to be concentrated in some sectors, geographical regions, and also individual banks. And then third, we underscore the importance of climate stress testing for assessing the relevance of climate-related risks. Our preliminary results indicate that acting early to limit climate change should have clear benefits for the financial system. Now, let me go to the next slide, which summarizes the policy implications. This is my penultimate slide. Over the course of the past year, the COVID-19 shock has evolved from what was at the beginning primarily a source of liquidity stress to what is now a source of solvency risk. So whereas economic and macroprudential policies were initially geared towards containing the immediate fallout, we have now moved into a phase where ensuring near-term recovery has become paramount. And that requires more targeted policy responses and balancing risks from cliff edges. Specifically, the phasing out of government loan guarantees and statutory moratoria. We're expecting that will reveal vulnerabilities on non-financial sector balance sheets, and that needs to be balanced against the risks of a misallocation of capital if those measures were to persist too long. We do have a special feature on zombification in the corporate sector in the review as well. And to address banking sector vulnerabilities, it's also going to require responding to uncertainties, including considering options for dealing with non-performing loans, and then looking further ahead and preparing for a post-pandemic environment. There will be a need to manage medium-term financial stability risks, including what we call a sovereign corporate bank nexus in the FSR, which is something I know you have worked on, Loriana. It also will require a strengthening of the institutional and policy setup, including completing the banking union, making progress with the capital markets union, and creating the space for macroprudential policy to respond to future financial crises. Let me wrap up with our overall financial stability assessment on the next slide. As I said at the start, the outlook continues to be dominated by the pandemic and its evolution, with risks for financial stability that are concentrated in some sectors and countries that had pre-existing vulnerabilities. The resilience of the financial system has clearly been tested by the pandemic, and so far, also thanks to policy support, it has continued to facilitate financial intermediation. So financial stability has been preserved. And as I said at the beginning, there are grounds for being optimistic that COVID-19 can be brought under control. For this reason, while we still see challenges, and some of them are listed here on this slide, our assessment of the financial stability outlook is somewhat more upbeat than it was 6 months ago. But as I said, cautiously upbeat, because we do see a number of sources of risk and vulnerabilities that are that could pose threats to financial stability going forward. So I can list here the possibility that global interest rates could trigger a market reassessment of premia. We also have concerns that, notwithstanding the high level of capital in the banking system, the combination of low profitability and asset quality issues may lower the resilience of the system to shocks going forward. And at the same time, we see growing balance sheet challenges facing the non-financial sector, while the vulnerability of non-banks, especially investment funds, to a range of plausible shocks has clearly grown. I'll stop there, Loriana. Thank you.
So thank you very much, John, for being on time as well. So you touch so many different aspects regarding the economic and the financial system that clearly they are all playing a significant role altogether. And I am suggesting to continue to provide questions, and then I'm going to the Q&A almost immediately. But I have a first point that will be nice that if you can elaborate a little bit more. You already give a good overview on the fact that different sectors has been affected in a different way. And also from the financial point of view, non-bank financial institution maybe have a role and an impact on the spillover, on playing a role in the risk spillover that can be different than the one of the banks or the non-financial corporates. But can you please maybe tell us a little bit more about what type of heterogeneity across countries you are observing? Because you are reporting, of course, the average, what you are observing in Europe in terms of average, but clearly we know that there is a huge dispersion as for firms having, some of them not increase too much their leverage level, and some other that do almost double it. And so what are the main heterogeneity that you observe across countries and across sectors?
Well, actually, Loriana, the heterogeneity to a considerable extent actually does reflect sectoral heterogeneity. I mean, the structure of euro area economies is different. I mean, we know that some countries are more reliant on tourism and activity, transport, and activities around that. So I mean, I had that slide, the chart on the right hand side of chart 7 that was showing the vulnerable sectors and the ones that have been hardest hit by COVID-19. And I mean, it's really in those countries where those sectors have above average levels in the economies where we see that. There is the structure. I mean, of course, there were also, differences going into COVID-19. I mean, as we know, on sovereign indebtedness, some euro area countries were more indebted than others. And I mean, we did also see a pattern of sovereign indebtedness tending to rise more in the countries that were already highly indebted. And that, I mean, I think that has been in part due to unfortunate circumstances, those economies being economies that had exposures to those sectors that were particularly hard hit. So, we have really been seeing this as a common shock that has hit, all euro area country. Okay, we know that the time evolution, what was different across euro area countries at the beginning, but it kind of normalized over time. That you get this kind of unlucky coincidence of having both vulnerabilities going in, and then on the balance sheet side, and then in addition these structural differences in makeup of economies. So I mean, I hope that I'm not going to start naming countries now, but I mean, I hope I give an idea, qualitative information there too.
Yes, yes. Yeah, so let me start from the question that are going to be asked by the participants. And one of the questions is from Nora, and she's asking, are you concerned with growing inequality both across EU countries and within countries in the aftermath of the pandemic? So clearly this is not the main objective of the ECB, but it is maybe the secondary one, So can you please elaborate a little bit on this concept?
I mean, yeah,
about inequality?
At least from I won't get into the politics, but on economics, I mean, I think it's absolutely clear that the COVID-19 pandemic had differentiated impacts on households depending on which income or wealth cohort that household happened to be. So, I mean, we know that the wealthier households, I mean, some of them have their wealth has grown, and they didn't lose their jobs, whereas the lower income households and less wealthy households suffered more. I mean, they were the ones, I mean, I guess, you know, talking about the people who would have been, you know, working in the retail trade, working in the entertainment trade. I mean, all those sectors where, you know, salaries and wages tend to be lower, and those were the people who you know, didn't have a job to go to because it was shut down. So I mean, yeah, absolutely. I mean, I think this is a big issue coming out of COVID.
But and then, you know, I'm picking up, you know, there are several questions also related to the moratoria and the fact that, you know, clearly they will be reduced, so the moratoria will be stopped sometime. And so do you have any, in the analysis that you perform, what is the, let's say, the different scenarios that you analyze in terms of when the public support, the fiscal, let's say, support, both in terms of moratoria or you know, direct support to families, householders, or firms will go to reduce? What is your, let's say, what are the different scenarios that you are using in your analysis?
So, I mean, to some extent, I mean, we have information on, you know, on the various schemes. I mean, details have been provided on when they're going to come to an end. And we can factor that into a baseline assessment. Of course, we don't know. You know, I mean, I think that there has been a tendency for in some jurisdictions to extend those. I mean, I think we were expecting that most of it would go away by around the middle of this year, but I think some countries are extending even into the third quarter. In terms of the impacts, you know, it's very difficult, Loriana. I mean, we don't have a lot of experience with this. You know, at times we don't have good time series models for forecasting. But I mean, I think what we are able to say is, I mean, maybe we're a little bit more concerned about credit risks going forward for loans that went into moratoria than we are for loans that went into that were guaranteed. And we are actually seeing, I mean, we have some data now, but it's very new, it's very preliminary in those countries where moratoria have come to an end. How are those loans performing? I mean, of course, you know, the big uncertainty is whether those loans will perform. Will people actually, you know, will they repay their loans when they're, you know, they've had a holiday for a year or more? I mean, I think overall what we're seeing now is that the performance hasn't drastically deteriorated. There's no big drama. But I mean, we can detect that, you know, that there is some deterioration in performance, and in loans that were in moratoria and came out of moratoria, they're not performing as well as the normal loans that didn't have any kind of support. But look, it's really early days yet, you know. I mean, I've seen, you know, I mean, from a financial stability perspective, you know, trying to think what's the worst that could possibly happen, and this is what financial stability people, of course, are paid for. What is, and you know, one of the fears is that there would be a breakdown in payment culture, and we've actually seen that in some countries. You know, where some people, you know, they don't pay their loans because their neighbour is not paying their loan. I mean, we're not seeing that so far. So I don't think that.
Yeah, you know, sometimes we are expecting from the ECB that is, you know, having the possibility to figure out all the possible things that can happen and have always the optimal solution. In fact, there is one question that is asking, what will be the optimal exit strategies from special support measure? You know, of course, it will be very nice knowing if there is an optimal exit strategies, but clearly we are all trying to figure out what is the optimal one by looking to the evidence. And clearly, I don't know if you want to elaborate.
Yeah, no, but I touched upon that a bit. I mean, I'm not sure that I would come, and it's optimal in the sense that it come out of a model. I mean, no, we don't have an optimizing model for that, but I think, I mean, the recommendation that we have been giving in the financial stability review is that there really is a need maybe to move towards more targeted measures. And in particular, I mean, the hard decisions have to be made about, you know, which firms are viable and which firms are not, because we think, and we had this special feature about zombies where we think that, you know, some firms that may not be viable in the long run did actually manage to get some support. We don't think it was dramatic, but we think we cannot exclude that happened. And of course, that is in the economy. Want to avoid that happens. I think my internet connection is unstable. I don't know whether it froze now.
Yeah,
Sorry.
well, don't worry. We were able to follow.
Okay.
Yes.
Yeah, no.
And
so I mean, I think we're kind of recommending a more targeted approach, and a more targeted approach, you know, of course, means doing the triaging and, you know, identifying the viable and the non-viable. That's easier said than done. We recognize, you know, it's a formidable task to do. But certainly, you know, it's the only direction we can go in.
yeah, well, this is also related. Clearly, we have also a question about zombie firms. So are you expecting, what is your forecast regarding zombification of both zombie firms and then, you know, so zombie banks?
Zombie banks. Yeah, we didn't write too much about zombie banks in the review. I mean, if you see the special feature, I mean, it's saying that, I mean, we cannot exclude that there has been some increase, but the comparison, I don't have the numbers in front of me now, but the comparison of, you know, and of course measuring the zombies, and we know that this is a very controversial area as well. I mean, you come up with a set of different indicators about the profitability and the long-term viability, whether the firms are in, you know, if they're investing or not, and if they're able to repay their debt. And we found that, you know, while it probably degree of zombification increased somewhat, it hasn't increased to the levels that were there at the time of the sovereign debt crisis, actually. So yeah, I mean, it may be an issue, but not
so far.
Not a dramatic one, at least not so far.
Good. So let me then go back to another question that is really related. Can you elaborate on your worries about the provisioning level of European banks? Do you have evidence which support these worries? This is Benjamin asking this question.
Okay. Yeah. So I mean, this is an issue. It's a good question, Benjamin, and it's something that we have been analysing very carefully. I mean, we've looked at this in a number of different ways, and one of which has been with a model, time series model, looking at provisioning patterns of banks over a 20-year period and using a large number of banks. And that model, when you don't take account of support, suggests that there was considerable under provisioning of banks last year. Because I mean, think about the magnitude of the contraction of GDP last year. Of course, your model is going to tell you that, if you have GDP as a determinant of non-performing loans. But then we did, so I mean, we were able to, we could see that kind of on a normative basis, non-performing loans looked lower given the fundamentals that had been relevant fundamentals over the last 20 years. But in addition, I mean, we know that there have been these supports, and we know that banks have been taking account of those supports. And so we did an overlay analysis to look to see to what extent were government guarantees and statutory moratoria explaining those differences across banks. And we do, and I can't say that this part of the analysis is a normative analysis in the sense of the other analysis, because it's more cross-section than it is time series. So we're able to explain why there are differences, and we do see differences depending on. So I mean, for guarantees, banks are provisioning less because, of course, the risk has been transferred to the sovereign. And for moratoria, actually, there is a tendency to provision a bit more, because I think that the banks may have an expectation that those loans are may not perform, or that there's a higher likelihood of those loans not performing when they come out of moratoria. We can explain, I don't know, about half, a bit more of the difference, but it still doesn't change the overall impression that there are some banks in Europe that may have under provisions, and we think that can be tied to profitability performances. There was, I think, a tendency for banks. We saw it at the beginning, for a tendency for banks to provision for what they could afford at the beginning of COVID-19. So there was a very high correlation between provisions and pre-provision profits.
Yeah, that
correlation stuff all after we see it again, actually.
Yeah,
the first quarter this year.
Okay, so there is another question from Ralph. Now we are moving from banks to companies again. Does company size matter for insolvency risk? Are SMEs or large companies more exposed to insolvency in the post-corona area? So what is your view, again, from the heterogeneity side?
Yeah, it's a good question. And I think that we are more concerned about SMEs than we are about large firms. I mean, large firms, I think, have, coped rather well and actually didn't need too much support. It's the SME sector. SMEs, of course, the SME sector is very diverse, as we know. It's difficult to generalize, and it depending on the sector and all of that. But yeah, I mean, our concerns are much more for SMEs than they are for large firms.
Yeah, and then going related to this, let's say, aspect on non-performing loans. So what is your point of view of an effective solution for non-performing loans? We know that there was already an issue regarding non-performing loans before in Europe. Now, clearly, the crisis is not going to solve this problem, but if anything, might exacerbate it. So what is your view? What is the, let's say, the solution that should be addressed, or the potential series of solutions?
Okay, so thanks for asking that question. Actually, that's a topic that I have myself worked on in the past, Loriana, and we published some articles in the ECB Financial Stability Review about how to tackle the legacy NPL problem. But I think that the recommendations that we were making in those pieces still stand. I mean, I think what we were saying is that there isn't a one-size-fits-all solution for tackling NPLs. And it's a very complicated issue, but I mean, maybe just one way of explaining why that is true is because the nature of the loans can be very different. I mean, I know that there are many people coming out advocating for, a silver bullet solution like asset management companies. And while we, certainly see the merit in asset management companies and have seen them work very effectively in Euro area countries, and the sovereign debt crisis, Ireland and Spain, for example, are good examples. Those kinds of vehicles tend to work best for a particular type of asset category. So in the Irish case, for example, it was commercial property, big loans, lumpy, easy to manage. When you get to things like SMEs, where there's a large degree of heterogeneity, it's much more complicated. And this is why we advocate considering other solutions, like, for example, securitizations or direct sales of assets. We have been advocating for a long time the creation of
secondary market for non-performing loans.
Secondary market for non-performing loans, exactly. So what we have called it the eBay, of non-performing loans. Part of the issue is that from a financial stability perspective, I think what's really important is to avoid that the banking sector is confronted with losses, an erosion to capital that are avoidable, just simply because the market is cornered and they get bad prices, and that has an adverse impact for financial stability in the long run, in my view. So a comprehensive approach is what we co-authors and people you know, I think that's the kind of the financial stability view on non-performing loans.
No, I'm sharing perfectly your view, and in fact, I'm also writing on this aspect. So now let's move a little bit to another question that is maybe more related to, you know, what the ECB is really doing, that is interest rate. And there is this question by Edgar. It will be that an interest rate shock in the United States would have an impact, you know. What type of spillover effect are you expecting from the US interest rate behavior to the, let's say, the situation in terms of financial stability in Europe?
Well, I mean, I covered that to some extent in the simulations that I showed, and I'm not going to start. I'm not going to get into monetary policy issues because it's outside of my scope of responsibilities.
Okay, so you know, from this financial stability point of view, then what are the most important, let's say, spillover effect that you are, let's say, in a sense, afraid and you are monitoring more in detail? Are the one coming from the linkage between corporate and sovereign? Are the one mostly coming from the interaction at the international level on how the global economy and the global, let's say, financial and economic cycle is going? What is your perspective for the financial stability point of view?
So what is our risk prioritization? Which risks
yes.
do we think are the most important? Yeah,
exactly.
Yeah, so I think, Loriana, I mean, it kind of oscillates a bit between what I was saying about exuberance in financial markets and the credit risk outlook for the corporate sector. And I'm saying it oscillates a bit because we were the credit risk outlook for the corporate sector, as I was saying in the presentation, has actually been much better than I think anybody would have expected. I mean, I think that's down to all of the supports, but we're only going to really understand the importance of those supports after they're lifted. So I think it's both of those two, and I mean there is, as I was saying as well, a potential interconnection between them as well. Actually, a rise of global interest rates, you know, I mean, in terms of all of the risks that we have, it is potentially a common trigger for all of them. So yeah, so that's I think that's the prioritization.
Yeah, and then going back to, you know, to the climate change and the stress test that you are performing and so on, there is a question also on the carbon tax and the you know, that part of the market that, you know, what is your opinion regarding the CO2 EU market, which explored above 50 euro per ton in terms of the demand generated by speculators or funds versus steel, cement, and other substantial, let's say, institutions. So what is your view regarding this market and the rest of the other market and, you know, all these issues regarding climate change?
Loriana, if you don't mind, there's a colleague, Stefan Farr, who's with me, who was involved in the preparation of that special feature, and he's a much, you know, greater expert on this topic.
I will be very happy if he's going to answer.
Yeah.
Hi, Stefan.
Hello. Yes, I'll step in for John for this question. So the CO2 market has become very important, and this price development, we see it as a very favorable development, because what we interpret here is that the market has become information sensitive. And what we have seen, for example, when the Commission announced the stricter kind of or stronger reductions in CO2 targets, this market further picked up. And so this part is, I think, a very important signal that this market is now functioning to some degree. We cannot say yet perfectly, but at least it is well, 2-3 years ago, the CO2 price was flat, close to zero. Now, this is now market or pricing versus regulation as an approach, and we just need to remind ourselves that even the CO2 market, these allowances are regulated, so they have a declining trend, and over time this will allow that firms will adjust, and those that have ease in adjusting their technology and their CO2 emissions, they will do so. And those that cannot or adjust or have difficulty to do so, they will need to pay this CO2 price. And so this is a nice financial instrument mechanism in the form of hedging. Now, what is our opinion, so to say, of additional regulation? We need to know kind of that these sectors that have been mentioned, the cement sector or steel, even within those sectors, firms are very heterogeneous in terms of their CO2 emissions. Hence, well, by regulating them one size fits all for each of those sectors, we might not be sufficiently granular with our regulation in taking account of the technological changes taking place and in the heterogeneity of individual firms within those sectors. So we need to see this transition risk and the CO2 emission kind of accompanied through market mechanisms on the one hand side, but also through the technological change and emission saving technologies. And so this needs to go hand in hand, and regulation works well if there are possibilities for substitutes, because we will still need to build houses. And if we have alternatives in the way we build houses, then yes, there can be a stronger push for regulation. I think that is the view that we have here. Thank you.
Thank you very much, Stefan. So let's move to the last question, because the time has run so fast, and is about non-bank financial institution. And the question that they are asking is, what is your view? What type of issues or risk are we going to see regarding mutual funds?
Mutual funds. Yeah. Okay. So I mean, I was, I think I was emphasizing in the presentation a lot the vulnerabilities that we see in the investment fund sector. So that encompasses also the mutual fund sector. And I mean, there have maybe a couple of points. One is that the sector has grown very large in Europe. I mean, it's now rivaling the banking sector. I mean, in size. It's an important source of financing. It has become an important source of financial intermediation. The investment fund sector is lending to the corporate sector, buying corporate bonds and so on. What we have seen in the corporate sector, in the investment fund sector over the last number of years has been a tendency to hunt for yield in this low interest rate environment, and that has led to a compression of a risk premium. I mean, and all the things that we know of. We work together on this topic, Loriana, the low interest rate environment. And we have some concerns that the riskiness of the exposures of the investment fund sector have increased significantly over the last number of years. And then at the same time, what we're seeing, and possibly also linked to the low interest rate environment, a tendency for investment funds to lower their cash buffers, their ability to pay investors quickly if investors want their money back. And I think that we cannot exclude that we could see a repeat of what we had last year, where, I mean, in fact, the investment fund sector was at the epicenter of the whole thing. I mean, I wouldn't go as far as to say it was a run, but it was close to a run that we had on the investment fund sector at the very start of COVID-19. Investors, asset prices were falling sharply. Investors tend to want their money back. It's very myopic, but that's what investors often do. They look to get their money back when asset prices are falling. The investment funds are not able with their cash balances to meet the daily liquidity that they're promising, and then they have various things that they can do. I mean, they can borrow or ultimately they can sell assets. And I think this is what we were seeing. We were seeing investment funds, so we call it forced sales, and that amplifies adverse dynamics in the financial markets. And so this kind of combination of, you know, very large size, higher risk on the asset side of the balance sheet, plus low liquidity buffers, makes the sector, in our view, vulnerable to asset market volatility, and indeed makes it systemic because it has become so large.
Okay, so I think that you know, unfortunately we have exhausted our time, but there is still a lot of other questions that maybe we can copy and send to you, and if you and your staff will be so kind to reply to some of them. There are something also more technical related to the models that you're using to do the prediction and so on. So it was very good. I think that we learned a lot, and actually it was the first, you know, experience that SAFE and CEPR is having with you regarding these financial stability reports. But clearly, given that this report, it has been done every let's say twice a year, we will be very happy to repeat this experience in the future, and you know, having you and your colleagues to try to let's say convey in a very simple way. Actually, I really like, John, the way in which you presented this document that is so rich, you know, so large, having a lot of results, but really focusing on the part that are the most important. So thank you very much, and thank you to all the participants, and see you soon in the next time. Bye-bye.
Thank you very much, Loriana. Bye-bye.